Hello. In today's special edition of Macro and Market Moves, we have Mr. Hariharan, Head of Sales at Emkay Global, with us today. Welcome, sir. Thank you for joining us. What is your FY23 outlook from the institutional perspective?
I think FY23 is going to be a year where we consolidate gains that we've made in the last 2 years. So if you look in Western countries, headwinds to earnings are coming from their monetary and fiscal constraints, which is not the case for India. India is in a much stronger position. The regulatory setup is supportive. The government has the leeway to spend more if it is required. And if you look 6 months out, then even RBI is going to be largely in a comfortable situation. So we'll probably have a situation where earnings growth remains quite strong and we end up having a time correction for valuations. So in all respects, when one looks at valuations, whether you look at India relative to the world or Indian equities relative to bonds, there is a certain richness of valuation, but that is underpinned by structural flows from households into equities, because of which I expect we will not see any meaningful price correction.
What are the current FII and DII trends for the Indian markets?
So if you see, foreign investors were sellers in the first half of CY22. They sold to the extent of about $35 billion. But the pace of selling has now diminished over the last 3 months or so. You must remember that in MSCI emerging markets, India's weight has gone up from about 9% to nearly 15% now in the last 1.5 years. Sure. So this itself creates a degree of synthetic underpositioning. And so one would expect that FII selling going ahead is probably going to be driven only by a macro shock rather than concerns of valuation disparity relative to other emerging markets. And on the other hand, DIIs are structural buyers, like I said, because of increasing household allocation to equities incrementally. And so far that flow is more than adequately offsetting FII flow. Volumes in general have been stable, but what I do expect is that as this period of macro uncertainty goes behind us, we'll see a meaningful bump up in institutional volumes and potentially a very supportive environment for the market.
So your quote in Hindu Businessline in August spoke about a synchronized recession in the EU, US and China. So how do you see this from an Indian perspective?
See, it's increasingly clear that there is a global growth slowdown, which is happening in response to tightening monetary action from DM central banks. And China has also imposed restraints on itself with regard to production. That is also having a dampening effect on global trade. Now, what is not clear at this point of time is whether this is just a cyclical slowdown that is coming because we had an abnormal bump post-COVID, or whether there is a structural element to this and this might end up becoming a prolonged slowdown. So far there is no evidence of a prolonged slowdown, I must add.
Yes.
And if that remains the case and this ends up being cyclical, then we'll probably see a hit of about 100 bips to Indian GDP in FY24 and no lingering after effects.
Okay.
However, if this gets extended, then we would have to think about meaningful adjustments that the economy will have to make. I mean, as things stand, we are on the cusp of a domestic Capex cycle. This is going to be our third go at such a thing in the last 10 years. And each of the last 2 instances were cut short by exogenous factors. So to that extent, yes, what happens with global growth is going to show up for us in FY24, not so much in FY23, about whether we end up having a meaningful growth slowdown.
So do you think the global recession and Indian resilience will drive FII flows to India?
So see, foreign investors already recognize the long-term India story. After their experiences with China and other emerging markets over the last few years, the structural advantages of the Indian market, the demographic advantages and the supportive regulatory environment, all of these factors are very well understood. but we are capital constrained and highly dependent on foreign flows.
Right.
So, to that extent, what happens in the global financial system and ebbing of global liquidity is something that is important. We are going to have a positive growth differential over the rest of the world, which means that we are going to be running a current account deficit. It's probably going to stay wide, and again the importance of global flows comes in. So, to my mind, oil and stability of the global financial system are the key variables to watch, because that is going to be the key determinant. And if there is any meaningful accident, which I know there are already concerns about, if anything were to come to pass, then that would definitely have an adverse impact on flows to us and would set us back meaningfully.
I see. So in this case, do you think there will be any particular sectors where we can see better inflow, or rather that can attract more FII flows?
See, the Indian consumer, especially the urban consumer, is very strong and it's well acknowledged. Consumer discretionary, what we are going to see is that India is now going to go through that same inflection point in terms of consumption that China did in the late 90s and a reasonable part of the developed world did in the early 60s in the last century. And as a result, consumer discretionary, especially luxury consumption, is going to be a sector that will always keep on attracting incremental institutional investment. Banks are the conduit for growth in incomes as well as spending. Okay. So that will be a sector. So financials, consumer discretionary, autos, these are going to remain the most favored sectors within India.
This is very helpful. Thank you so much.